Hello and welcome to Earnings Echo. We put together the most important information about Sea Limited. Looking through your notes on their Q4 and full year 2025 results, the top-line growth seems massive at first glance, but the market's reaction paints a much darker picture for your portfolio. Let's get straight into the hard numbers to see where the cracks are actually forming. What are the headline figures for the fourth quarter?
Well, Q4 2025 GAAP revenue hit nearly $6.9 billion. That is a 38.4% jump from last year, but the diluted earnings per share, the actual profit attached to each individual share that came in at just 63 cents.
Wait, 63 cents. That is a severe miss compared to the 80 to 90 cents analyst consensus. Is this earnings miss the primary reason the stock took such a heavy beating right after the release?
The massive sell-off is a combination of that earnings miss, escalating operational costs, and honestly, a broader macroeconomic risk-off environment. With current geopolitical tensions, emerging market tech stocks are often the first assets to be liquidated from institutional portfolios.
All right, so if investors are already skittish, seeing those costs spiral wouldn't help at all. Let's look at their e-commerce swing, Shopee. How is the top line holding up against the actual expense of running the platform?
Shopee brought in $4.3 billion for the quarter, growing roughly 35.8%. However, the cost of revenue surged over 40%, heavily driven by the logistics required to fulfill higher order volumes. Plus, sales and marketing expenses climbed over 33% to more than $1 billion.
They're essentially burning money on the front lawn just to make sure TikTok Shop and Lazada don't buy the house next door. If e-commerce is bleeding cash to fight a turf war, what about their financial division, Money?
Money's revenue actually jumped 54.3% to $1.1 billion. But there is a glaring red flag in the data. Provisions for credit losses spiked 66.7% compared to last year, hitting $393.1 million.
Setting aside almost $400 million just for expected bad loans is bound to spook the market regarding the quality of their loan book. Do the actual default rates reflect this level of risk?
The NPL 90+ ratio stayed flat at 1.1%. Even with total outstanding principal growing 80% to $9.2 billion, current defaults remain stable. The market, however, is pricing in the future risk of expanding credit that rapidly.
That leaves the digital entertainment segment, Karina. Was there any positive momentum there to offset the margin squeeze elsewhere?
Garena delivered solid stability. Q4 bookings went up almost 23.8% to $672.4 million. In a quarter where Shopee is torching cash for market share and Money is stockpiling reserves for bad debt, Garena's reliable cash flow is a crucial counterbalance, keeping the broader ecosystem afloat.
With all these moving parts, aggressive spending, and rising credit risks, how did management defend this strategy on the earnings call?
CEO Forrest Li maintained a highly confident tone, framing 2025 as a record year that exceeded initial growth expectations. He heavily emphasized their scale, pointing to 400 million active buyers on Shopee.
Confident about the user base, sure, but what happens next year? Did management actually give a financial game plan for 2026?
They aim for roughly 25% growth in GMV on Shopee. Critically, management explicitly guided that full-year adjusted EBITDA will be no lower than 2025 in absolute dollars.
Capping future operating profit at current levels is a massive signal. It means C is strategically prioritizing aggressive growth and market share defense over near-term margin expansion.
Exactly. The long-term investment story here is fundamentally about a company achieving record-breaking scale, but paying a steep, tangible price to sustain it.
For your portfolio, the core echo you need to take away today is the necessity of weighing this impressive top-line acceleration against mounting operational headwinds. You have to balance Shopee's sheer volume growth against the margin pressures in e-commerce.
And simultaneously evaluate the rising credit risks within Matami. But here's something else to consider. If Sea Limited succeeds in starving out its competitors through this massive cash burn, will they actually be able to raise prices later to recoup these losses, or have they permanently trained their 400 million users to only shop when there is a heavy discount?
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.